We have Sonal Verma, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura, joining us. Sonal, great having you. Hi, this is Harsha. Let me first start off, Sonal, by probably setting the context. We've seen sustained FII outflows, which has pressured the rupee, of course, which has led to further FII outflows. What are you expecting in terms of policy, especially from the budget? What can be done to try and probably repair this, if at all it needs repairing?
Yeah, so I think the sentiment clearly is taking time to turn, even though, I mean, we do think things are changing at the margin. The growth numbers incrementally are looking better. Fundamentally, in terms of real interest rates, remain quite high. And the overall, the India-EU trade deal has also been sort of a positive. So sentiment is taking time to change. Now, in terms of what the budget can do, is basically, focus not so much on the tactical issues, but more on the medium-term game plan. So signaling in terms of continued fiscal consolidation, signaling on reforms, ease of doing business, that India is open to more investments from foreign investors across manufacturing, expanding the PLI scheme in infrastructure. So I think a mix of, fiscal consolidation plus signaling on reforms and various growth opportunities. That's what the budget can do. And ultimately, we do think sentiment will catch up with fundamentals, which are turning more positive.
Sonal, hi, morning, Sajid here. One of the key metrics I think which the street would now be looking at is the debt to GDP ratio. And the finance minister is also, indicating to us the change in, this metrics from a fiscal deficit target to a debt to GDP ratio. Do you see that, being, do you see that coming through, and will there be a path for that now?
I mean, that is the big change this time around, that India is sort of moving from this deficit targeting to a central government debt targeting regime. So from 56.1% in FY26, the target is to take it down to 50% plus minus 1% by FY31. So FY27 basically marks the first year of the shift to a debt targeting framework. So this is sort of uncertain for all of us, because we don't know what this really implies in terms of the fiscal deficit targets of the government, which we have been focused a lot more on. Our assessment for FY27 is the government will target its debt to GDP reduction to around 55% from 56.1% in FY26. And consistent with that, we think the fiscal deficit target for FY27 will likely be set at 4.2% of GDP.
The finance minister has been vocal about the fact that some of the states also have a high debt to GSDP. Do you think that there would be some kind of fiscal measures or incentives given to states to make sure that they are also prudent in terms of debt when it comes to raising finances for them and raising revenues for them?
I mean, absolutely. I think the idea is for the general government debt as a share of GDP to come down. So alongside center, we also need consolidation on the debt side from state governments. But the platform to do this is not necessarily the budget. There needs to be sort of more consultation separately on this aspect. But some of the transfers that the center makes to states, for instance, the CAPEX loan, that is linked to certain reforms that either state enact. So some of these center-related transfers could be linked to these incentives to get states to be fiscally more prudent. But proper framework of debt to GDP at a state level, I think requires a lot more discussion and at a separate level. And just to note that starting FY27, we'll also have recommendations of the 16 Finance Commission get implemented. We don't know what the tax devolution, share, how that will change, what are the other suggestions that are going to come out from the 16 Finance Commission. So maybe that has some more suggestions on state level debt. But yeah, I think in general, I think, there is cognizant of the fact that states also need to bring their debt to GDP down.
Okay, Sonal, hi, morning. The economic survey is going to be tabled very shortly from now. Given that macros for us have largely been supportive in the year gone by, do you believe that the FY26 GDP outlook or the initial half of FY27 GDP outlook could be raised in the survey?
I think in the survey, the focus is actually going to be more on the overall projection for FY27. So we do have the advanced estimate already for FY26, a 7.4%. So the shift, the change in the GDP methodology to a new base year in end of February, will cause some changes to the GDP growth rate, but it's difficult for the economic survey to make a judgment on what that shift will be. So what we'll be focusing on is the broad FY27 projection. Our own projection for FY27 real GDP growth is 7.1%. Typically, the finance ministry tends to give a range on their growth projections. So we would think a range, plus minus 7% should most likely be what they also expect.
How should, Sonal, it's going to be a critical balancing act, right? There is a need to spur consumption. There is a need to support CAPEX on the private side as well, and as well as on the public side in terms of infra and the like. And there is a need to critically balance the deficit. How do you expect that those three will likely get balanced, and whether that's a realistic balance or should maybe a year or two get discounted and thereafter this balancing should get rebooted, given the fact that there is uncertainty in the geopolitical environment?
Yeah, I do think it's a less difficult balance actually going forward. It was a lot more challenging, in fact, in FY26, because we did see this sharp slowdown in nominal GDP growth. Tax buoyancy came down because of the nominal growth slowdown, plus the personal income tax cut and the GST cuts. So actually, if we sort of look forward, we are expecting a pickup in the economic cycle. We think nominal GDP growth will pick up from 8 handle to closer to 10%. So some of the moderation in tax buoyancy actually should be a less of a concern going forward. And the GST cuts have played an important role already in stabilizing consumption coming on back of the personal income tax cut. And finally, because we're moving to a debt framework, the pace of fiscal consolidation will be slower in our view. So we've seen in the last 4-5 years, annually we've been targeting a consolidation by 0.4-0.5 percentage points. In FY27, we think the fiscal deficit target will come down to 4.2 from 4.4, so about a 20 basis point consolidation. So I think if you put it all together, we are in a good place, and I think this balance can easily be met as nominal GDP growth picks up, tax buoyancy picks up, and CAPEX, public CAPEX, we think will be maintained at 3.2% of GDP, i.e. Capital expenditure of the central government, rising at 10 to 11% year over year in FY27. So it should be a relatively easier balance next year if globally there are no shocks.
Sonal, when we began the year, we estimated the nominal GDP to be around 10 to 11%, and that was the base on which the finance minister also projected the tax revenue growth. Do you see significant cut in expenditure in order to meet the fiscal deficit target which has been set out for in FY26. And since we are moving away from fiscal deficit targeting to debt to GDP, nominal growth still plays a bigger role there.
Yeah, absolutely. So, I mean, on FY26, the moderation in tax revenue growth on our estimates is substantial. So, we think relative to the budget estimates, tax revenues will be around 1.5 trillion less than what was budgeted. And therefore, to meet the 4.4% target, some compression on expenditure is likely in our view. And I think there's also an important signaling aspect here that we need to remember. This is the final year of the fiscal glide path. We have met the fiscal targets year after year, and therefore, as we embark to debt targeting, maintaining that credibility requires, I think, that the final fiscal deficit target of this glide path is met. So we do think 4.4% will be met, and the revenue shortfall will be met through some expenditure compression, which we think will come from the revenue expenditure side. On nominal GDP growth, I mean, our expectation, as you said, as we move towards debt targeting, there are two important variables that actually drive debt to GDP. One is your assumptions on primary balance, and India runs a primary deficit of about 0.8% of GDP right now. And second is your, the differential between your nominal GDP growth and the cost of borrowing. So both these, actually all three factors, which is, the nominal GDP growth, the cost of borrowing, and your primary balance will determine the speed with which the debt to GDP comes down. So it's not as simple as fiscal deficit, which is maybe more in the control of the government, because nominal GDP, cost of capital can change because of things that are outside your control. But yeah, these would be sort of more important variables to forecast for debt to GDP going forward.
Do you see a revenue deficit now coming back into focus as part of the new framework?
I mean, the new framework will focus on the debt to GDP. And as part of that debt to GDP, there are certain variables that drive debt to GDP, and therefore, yes, we think primary deficit will come back into focus. Nominal GDP growth will come back into focus, but markets and investors, we've all been used to focusing a lot more on the fiscal deficit as a share of GDP. So even as the government shifts towards debt to GDP, we do think the broader focus of the community, investor community, analyst community on deficit as a share of GDP will still stay. And that's partly because your net borrowing and gross borrowing numbers will depend on what the fiscal deficit is and what share of the deficit is being financed through market borrowing. So yeah, the center probably de-emphasizes deficit to GDP as an indicator, fiscal deficit to GDP, and focuses more on debt to GDP. But from the market standpoint, I think the deficit focus actually will continue.
Okay, and Sonal, curious to know your view with regard to gold and silver, precious metals. They've come to the fore, in fact, since maybe 2022, 2023, but you're really seeing a rally now. I know you can't comment with regard to that, but what do you make of the entire de-dollarization theme which is playing out? Can it continue to play out? And therefore, if it were to, would the natural conclusion be that we'll continue to see a rally, maybe?
I think in general, the fragmentation we've seen on the trade front, on the geopolitical front, it has become quite important for countries to diversify. And this diversification, as we are seeing on the trade front, with India trying to, sign up free trade agreements with, many other countries. The same applies on the investment front in terms of diversifying where you invest and sort of not putting all the eggs in one basket. So I think the broader theme of diversification is in play, and we are seeing this in terms of central bank gold buying also. And India is, of course, one of that, but this is a trend we are seeing across many other emerging market central banks. So we do think the new world order that we are in, where there is greater uncertainty, there will be more diversification and more demand that's going to come through. Now, the actual flow picture in terms of de-dollarization is not clear cut. But there are other macro catalysts that will become important going forward this year for the dollar. So the new Fed chair that is, who is expected to come in, can reignite concerns around Fed independence. And we think the US Fed will cut rates twice this year once the new Fed chair is in place. So some of these factors could also shift the interest rate differential away from US favor. So our view on the broad dollar, which is, of course, an important driver of the various commodity prices as well, is, some more dollar weakening, particularly in the back half of 2026.
Okay, thank you so much, Sonal, for joining us this morning, giving us all of those views. It was a comprehensive conversation, and of course, with the economic survey in focus, we'll have